Okay, let's take a look at exercise 11-2. So this is on journalizing partnership entries. So on April 1st, Harry and Megan formed a partnership, and here are the details: what they contributed, how they're sharing their profits, and what cash withdrawals they had during the year. Net income during the year was $177,000, and it was in the income summary account, so all that's been done. Part 1. Present journal entries to record the initial capital investments of the partners, their cash withdrawals, and the December 31st closing of the income summary and withdrawal accounts. And in Part 2, determine the balance in each of their accounts as of the end of that year. So we'll start off their contributions. So one contributed $97,000 in cash, the other contributed land and a building. So we debit each of those accounts, because by debiting these asset accounts, we're increasing the value in that account. So we debit cash $97,000, debit land $137,000, debit building $50,000. Then we credit their capital accounts accordingly to what each one contributed. So Harry had the cash that was $97,000, so we credit his capital account for that $97,000. Megan Merle contributed the land and the building, which totaled $187,000. So her capital account gets credited with that amount. Then we're going to record their withdrawals. So Harry had $77,000 and Megan had $62,000. So we debit their withdrawal account, individual account by each of those amounts, and we credit the cash account then, because for the total amount of the both withdrawals. Close out the income. So it's $177,000 in income. So that would be sitting there as a credit. So we'll debit that, and then we'll credit each one of their capital accounts again. And they get credited. Oh, yes. Profit sharing, so they have one of them gets a salary, and then it's 15% of their original capital investments. So we're going to scroll on down. This shows you here the calculation. So there was $177,000. The first thing that happens is Harry gets his salary allocation of $107,000. That leaves $70,000. That leaves $70,000 left over, and then they get 15% of their original capital investment. So Harry gets 15% of the $97,000 that he originally contributed. Megan gets 15% of the $187,000 that she originally contributed. That gets added on for their totals, and that leaves the 107 plus the 14,550 plus the 28,550 ends up being a allocation of $149,600. So they had $177 there to allocate. We've now allocated $149,600. So that means the remaining profit to be allocated is $27,400. It doesn't say anything in the question, so therefore bearing any balance shared equally. There we go. Say bearing anything else, if there's no indication, it would be shared equally, but they actually do say in this question that it was shared equally. So then they both take 50% of the $27,400 to allocate out the remaining profit. So then their shares are here, $135 and $41. So we close out the income summary by debiting that account, and we credit each of the partners the amount of the profit that we just calculated. Then we close out the withdrawals account. So as you can see here, when the withdrawal happened, or to record the withdrawal, we debit the withdrawals account for each of the partners. Now we go ahead and we credit that amount, and we debit the amount to their capital account to reduce their capital contribution. Then, in Part 2, determine the balance. So their initial investment, which was given to us, the withdrawal here of $77 and $62, then they get a share of the profits, $135 and $41, to give us their ending balance at the end of the year. All right, that's it for that one.